Today, we're taking a look at a stock that maybe even dividend investors and value investors can get behind, and that is CISCO Systems Incorporated, ticker CSCO. So we're looking at the chart here. I've already run the numbers as usual, and we're taking a look at what's the fair value, what's a buy range, what's a sell range, and what's fair. So I'm looking for, at least with the current market, somewhere between last year's financials and the guidance for this year are where these numbers lie. So we're looking about $40 and below for a buy, 47 is about fair, and 52 is when we should be looking at selling out. So we see that it was trading for a pretty good premium for a little while, and then about a year ago, it dipped into our range and it came underneath the sell, touched the buy a few times. So it would have been a great time to buy October of 2022, and it's been going back up ever since. Right now it's above the fair value, so would probably be a hold in my book, just based on how the stock has performed fundamentally. Technically, it looks like there might be a little bit more upside. It might hit our sell range with this leg up. Now let's take a look at these numbers that I'm talking about and see what's going on there. So as I have done recently, I pulled their guidance out of their earnings, their most recent earnings, and tried to project out a little bit further. So looking over the earnings, we don't need to dig through all of that. I pulled out all of the important numbers, so we can just go straight off this sheet. We see not the best company on a 3-year compound annual growth rate. 2019 was a good year for them. They took a huge dip in 2020, and it's almost like it was a reset that they've been heading back upwards since. They're expecting to come in with 10 to 10.5% growth in revenue this year, which is great. That's in line with what we want to see. Their earnings per share, they say that they're going to come in with $2.98. So they're continuing that growth trend that we've seen them on. And they've been good at buying back shares, nearly 2% year over year. So we're assuming that trend is going to continue, which it looks like it will. Free cash flows, they have strong free cash flows coming in almost 25% of their revenues, make it all the way down to free cash. This has been shrinking a little bit over time, but if they can keep bringing in that approximately 25% off of their revenues, we'd be looking at numbers such as these for their free cash flows, which would be very nice. Assets, they've been shrinking in their assets year over year, and they have been shrinking faster in their liabilities. So the balance sheet, the asset trend is not good, but liability trend is better. And I even entered a 2-year compound annual growth rate for all these numbers, just so that we can cut out that 2019 and see 2020 was a reset. How are they doing from then? And we see revenue does go positive, not a massive amount, but it is positive. And then we see larger growth in the earnings per share. So those are two things that improve once we cut out that 2019 number, and that's something to note. The dividend, they are a strong dividend payer. They paid out right now, they're paying out $3.14, right now they're paying out $1.56, and that converts to a 3.14% yield, which is a strong yield. They've been growing this dividend at about 3% every year, and we can see the same trend going 2 years. So I'm projecting it's going to be about that 4-cent raise moving forward. 1 cent a quarter is a pretty fair. I mean, for an established company, it's about as low as you can really go, 1 cent a quarter. So hopefully they can at least keep that up going into the future. And then we see that their PE, over the last few years, on average, they've been around a 19 PE. That has been shrinking recently. The market's been factoring less growth. So it's made its way all the way down to it's currently at 16.7. And then we can see all of the valuation metrics here. So the majority of the value is coming off of those cash flows. And if we look at a discounted cash flow, you can tell that, I mean, that's saying that $99 a share would be a decent value based on all of the variables that I gave it for the cash flows of this company. But we see that the earnings put it in the higher 50s going forward, mid 50s at the moment. Balance sheet, not the best. It is going up, at least in our projections. There was a bit of a dip this last year. And then the dividend puts it a little bit higher than it currently sits. That's about the sell range that we'd want to see. Because we have on this year's guidance, buy of $40 and below, a sell of 52 and above, and going forward it'd become 41 buy and 53 and a half sell. So I'm trying to project it out to the future a little bit more and kind of find, okay, it's a little bit expensive for today, but with the rate that they've been progressing, where might it be in the next 3 to 5 years? At the current price, it wouldn't be bad in 5 years. I mean, we would definitely like to see it lower. Around the $40 mark would be ideal. So a $10 drop from where it's at, that's kind of large for a $50 stock, but we'll see how it goes. If it gets rejected off of some of the resistance that it has here around the $51 level, or if it doesn't even make it up that high and starts to head back down. We could see how low it goes. Just recently, I mean, it had gone down to below $40. So there's a possibility. One trend that I do see is off of this $30. We got one, didn't quite touch here. Maybe we can do it like this. Yeah. It just broke below there. We do see it's got a pretty good long-term trend running right here. It did break below for a little bit, but it caught right back onto it. So if it gets rejected, we might see this intersection here getting hit and it'd go right back down to the fair value of the stock. I'm trying to bring you guys faster videos and just give you all the information that you need. You can always pause and look through the spreadsheet. This is the main factors that you need to know from a company over the last 4 years, projecting out 2 years. So that's quite a bit of data to be able to look through and decide, hey, is this on the trend that I want it to be? Do I want negative 0.2 growth in the revenue? It might be delivering almost 3% on the bottom line, but if the top line's not growing, there's only so much they can cut in their expenses. So I want to thank you guys for watching. Please like if you enjoyed this video, subscribe if you want to see more like it, and let me know if there's any other companies you want me to take a look at. I'll catch you next time.